We're going to look at another company here. So this company produces a bottled soft drink. Our company has two production departments, the syrup department and the bottling department. When we begin June 1st, we have 1,000 gallons of syrup mix in the syrup department inventory. We brought over costs of $4,400 for our work in process cost. The mix was 100% complete with respect to its direct materials, but only 40% complete with respect to its conversion requirements. So at the beginning of the month, we have 60% more conversion to complete. We have additional information on the next slide. So we started 76,000 new gallons of mix in addition to the 1,000 that we already had in process. And we transferred 75,000 gallons of finished mix to the bottling department. Our production costs were $304,000 of direct materials and $75,000 of conversion. Conversion is partially direct labor and partially overhead. At June 30, there were 2,000 gallons of partially processed syrup mix remaining. The mix was 100% complete with respect to its direct materials, but only 20% complete with respect to conversion. On the next slide, we're going to see the process costing production report. So we have our 1,000 beginning units. We started an additional 76,000. So the total units we had in production in June were 77,000. Our ending work in process was 2,000. We transferred 75,000 to the bottling department. We had 1,000 in work in process at the beginning of the month. So the ones that were started and completed in June were 74,000 units. After we've looked at the physical flow of goods, then we will calculate our equivalent units. So those first 1,000 units in our beginning work in process inventory, remember they were 100% complete for direct materials. So we're going to have 0 equivalent units for our direct materials. They were 40% complete for conversion. They need another 60%. So our equivalent units of those 1,000 work in process units is 1,000 times 60%, or 600 units. We have units that were 100% started and completed in June. And then we have 2,000 units that are 100% complete for direct materials and 20% complete for conversion, giving us 76,000 total equivalent units for direct materials and 75,000 for conversion. We then have our costs incurred during the month of June. We had 304,000 in direct materials divided by our equivalent units of 76,000, giving us a cost per equivalent unit of $4 for direct materials. Our conversion costs for June were $75,000. We had 75,000 equivalent units, so we have a cost per equivalent unit of input in June of $1. Then the last part of our production sheet is to apply cost assignment. So we had costs that we had our beginning work in process of $4,400. Then we have the costs added during the month of June. So our direct materials and overhead costs that were added during the month of June, giving us our total cost to account for of $383,400. We apply those costs to our equivalent units of production to tell us what is in our inventory at the end of the month. So we have total costs of $383,400. Of those costs, $308,000 are applied to direct materials and $75,400 is to conversion costs. So for this beginning units in production, we had 1,000 units and our 600 units. Cost to complete, the beginning work in process, and then we have the units started and completed during the month. If we go back to the previous slide, we see that we had 74,000 started and completed during the month. When we see how this flows from the T accounts, we started with a beginning balance of $4,400. We added direct material, direct labor, and overhead. At the end of the month, we transferred 75,000 gallons at a unit cost of $5 per gallon, which we calculated with the $4 for direct materials cost and $1 for conversion costs. We transfer those costs along with the gallons to the bottling department. The bottling department then adds their own costs, $400,000 in direct materials, $5,000 in direct labor, and $20,000 in overhead. Their total cost tells how many bottles of cola we made and what the unit cost is. Those finished bottles get transferred to finished goods. When we show our production report, which we just walked through there, it's a summary of the work completed during the period, our related costs, both per unit and the total costs. The appearance of these reports might vary from company to company, but they all have the same common sections. When we use this process costing data, we're going to use it to set our sales prices, to evaluate the efficiency of our processes and our departments, to forecast what our future manufacturing costs might be, and to value our inventories and measure our cost of goods sold on our financial statements and our income tax returns. So this is why cost information is so important to us. We want to make sure that we're getting the best cost information as possible for our company. So then we're setting good sales prices and we're recording the correct inventory values and profit margins on those materials. When we use that information to evaluate departmental efficiency, we're only going to look at the costs incurred in each department. So what does that department do to control their own costs? Are they wasting materials? Are they not using their direct labor efficiently? Those are the kinds of things that we're going to look at when we're evaluating them. We compare our current period costs for materials, direct labor, and overhead with any budgeted costs or with the previous period's costs. And we'll look more at budgeting and performance evaluation related to budgeting in a later chapter. We also talk about ethics, fraud, and corporate governance in accounting. If we are incorrectly valuing our overhead, then all of our financial statements are incorrect. If we overcost or undercost our inventory, we record an incorrect cost of goods manufactured and sold, then we will record an incorrect profit margin and can record an incorrect net income. That is the end of chapter 18.